So, is Nike's sports supremacy enough to justify its high valuation? Welcome to the Valuation Master Class case study, where you'll learn about interesting stocks and how to value them. What's interesting about Nike is that if you would have invested $1 in 1982, you would have $64,000 today. This is Andrew Stotz of the Valuation Master Class. Let's get started. Remember, this information is for learning purposes only. This is not investment advice or a recommendation. Nike is in the consumer discretionary sector in the US. It's the largest manufacturer of footwear and sports apparel in the world, with an estimated brand value of over 30 billion US dollars. There's three things to know about this company right now. Digital expansion bears fruit, driving top line growth. Reengineering retail business could enhance margin further. And competitive position means profits beat those of biggest rival. Some key statistics, analyst consensus. First of all, there are 38 analysts covering the company, and consensus has the target price at $185 US. That's a 29% upside or a buy. The PE ratio is 29 times. That's pretty expensive. Dividend yield of just 0.7. My value estimate is 112. That's a downside of 22%. And that would mean a sell versus the market's buy. So let's look at the sales of the company. Footwear account for 66% of sales, clothing 30%, and equipment and licensing 4%. Breakdown by region, North America accounts for 41% of total revenue. Europe, Middle East, and Africa account for 27%, and just China accounts for 19%, while Asia, Pacific, and Latin America account for 13% of total revenue. Now, the share price has shown strong, high volatility over the past few months, going from a low of about $130 US up to a high of about 175. And right now it's at about 150. Most recently, the 50-day moving average has fallen below the 200-day moving average, which could be the start of a bearish trend. Now, volume relative strength index is still slightly above the 50% line, but not providing any clear signal. So what's the story? The first one is digital expansion bears fruit, driving top line growth. Digital sales already make up about 25% of Nike's revenue in 2021, compared to just 5% in 2014. So it's been a major ramp up. And of course, that ramp up really went up from 12 to 25% in the 2020 economic crisis caused by the government shutdown. Now, compared to its competitors, Nike already expanded early into its digital channels, which delivered high growth. Especially during the pandemic, its early efforts really paid off. The new normal could continue to push digital sales up further. So let's now talk about digital penetration is part of its strategy shift. The company increasingly focuses on direct-to-customer sales. Under its campaign, Nike Direct, it aims to promote its own retail stores and expand its online platform. The objective is to create a mono-brand experience and reduce the reliance on wholesalers. As a result, Nike can yield a higher average selling price. The Nike app that I'm looking at, that I've put in this presentation, shows a little bit about what they're providing there on the iPhone and Android phones. But the key thing is that if they can go direct to the consumer, they get higher margins. They get to keep margins. So how have I incorporated this story into my forecasts? I've been forecasting expanding digital sales, and that's a key growth driver in the future. So if we go back to 2019, digital accounted for $5 billion US and non-digital 34 billion. Now, by 2024, I expect that digital will be $18 billion and non-digital will be $39 billion. So it's really getting up there as far as digital penetration. Now, the point number 2 is re-engineering retail business could enhance margin further. In 2021, Nike's direct sale made up 35% of total revenue compared to 26% in 2017. By 2025, the company aims to ramp up the contribution of direct sales to 50%, cutting out wholesalers and the margin that they have to give away to those wholesalers. Wholesaler partners tend to offer larger discounts when reselling, and also that can sometimes devalue the brand. The shift also enables Nike to regain price control of its products. Now, cutting out the middleman should result in margin expansion. Focusing on direct sales could enhance Nike's gross margin by about 2 percentage points over the near term, with future potential upside over the long term. Right now, the gross margin of Nike as of 2021 was about 45%, and it has the potential, I'm forecasting by 2025, to go up to about 46.5%. That's already a huge margin. The average company in the world has a gross margin of about 29%. So this is nearly double that. In my opinion, this strategy makes sense as the company is unlike its initial growth stage, is no longer dependent on wholesalers to raise brand awareness. So how have I incorporated this into my forecast? Well, looking at the number of retail stores, scarcity creates demand. Nike continues to reduce its own retail stores, making their products more desirable. This kind of reminds me of Hermes, where they have a very small number of stores worldwide. Well, Nike's got a lot of stores, about 1,000 stores, but that's nothing compared to the shoes that they sell. So these are premium places. So also, the increasing management's efforts to shift to direct sales should be rewarded with a significant growth margin expansion. Gross margin was about 40, let's say ranging between 43 and 45 from 2019 to 2021. And let's say I'm expecting it to go up to 46.5 by 2024. So a small increase. Now, competitive position means profits beat those of biggest rivals. Nike's 5-year revenue, 6.8% CAGR, was 4 times that higher than the second largest sports giant, Adidas. ROE of 37% at Nike clearly beat the 21% at Adidas, while ROIC was 2 times larger than Adidas. Nike's profit is remarkably high. Of course, the risk is that it can only fall from here. Meanwhile, Adidas has room to improve. That's one of the possible themes here, is that margins are so high that it seems hard that it can maintain them at that level forever. Now, let's take a moment and try to answer the question, what is the role of cash in invested capital? Here, I've compiled a table. This table shows 19-year average numbers for companies globally, and they're in US trillion dollars. So to look at this table, we can see that the average number of companies that I'm looking at is about 12,000 companies. And the amount of debt on the balance sheet of these 12,000 companies is $11 trillion. And equity is about $16 trillion. That means invested capital is 26.7, the combination of these two. But remember that invested capital is reduced by cash and long-term investments because these are not core operations items. Now, to be technical, we really don't reduce it by cash completely because we need some operating cash. But generally, when we do a return on invested capital calculation, we just remove all cash. But truthfully, we know that we should be just removing the non-operating cash. Now, it's impossible to know what is operating versus non-operating, so we'd have to make some guesses there. But the point is that if a company has high amount of cash and long-term investments, then the invested capital is going to be reduced significantly. And that's going to cause what I call the operating invested capital to come down. And here we can see operating invested capital at about 21 trillion US dollars for all companies in the world. And that's the average of all companies. And then we have consumer discretionary, which is a much smaller sector. But I'm trying to understand how to compare these two. Next, we look at net operating profit after tax, and we can calculate the ROIC. That's simply net operating profit after tax divided by the operating invested capital. And that's 9.4% for the global group of companies, and it's 8.8% for all 2,127 globally consumer discretionary companies. Now, you'll also notice that the ROE of the global companies is at 11.8, and it's the same for both. The point here is that ROE is always going to be higher than return on invested capital, because ROE is based upon the E in invested capital, whereas debt is ROIC is based upon the debt plus the equity in the invested capital. So there's massive value creation, but I believe it's already priced in. In 2021, Nike delivered an astonishing ROIC of 69% and could maintain that heightened level over the short run. I forecast that Nike can grow its extreme level of ROIC over time as it generates a lot of cash. What do I mean by that? What I mean is profitability could stay the same, but if it generated more and more cash, that would cause the invested capital to fall, and therefore the ratio of return on invested capital to rise. You can see that ROE is not affected by that. In fact, ROE is going to go from a high of about 58% or so down to about 45 or so in 2022, and then down again to about 40. Now, already that's massive numbers, but this gap between the ROIC and the ROE is something that is explained by the accumulation of cash on the balance sheet. Still, it does not lead to any upside, which makes me assume that the consensus is too bullish about Nike's prospects. Remember, I'm putting in this very high ROIC into my forecast. So how have I incorporated this story into my forecast? Well, what you can see in the table I'm showing you now is that the ROIC and ROE, I'm expecting, well, ROIC to rise all the way up to 83.4% in 2024. So these numbers are very optimistic, but they're realistic as of right now. But the point is that realistic, or let's say that very good story is already in the price. Now, scan this QR code or click the link to go to valuationmasterclass.com blog to download all case studies for free. Now let's look at the Fvmr Scorecard, which measures attractiveness relative to all other companies in that market. We base a score on 4 elements: fundamentals, valuation, momentum, and risk. And we rank the company from 1, best, to 10, worst. So Nike looks pretty good on most measures, but is weak on valuation. Why? Because relative to 2,160 non-financial companies in the US, Nike is expensive. Price to sales is about 6 times. Price to earnings about 44 in the past 12 months earnings. And price to book is 18, almost 19% or 19 times, which is massive. But let's look into the fundamentals. Why is the valuation so high? Well, here I show that the return on equity, this is the recurring profit return on equity, is now up to 50, more than 50%, let's say. That's a massive level. Again, it's a very high level, so you could argue that the only place to go is down from there. Now, recently I created a short online course explaining my Fvmr investing approach. I usually sell it for $97, but for a limited time, I'm offering it for free. Just click the QR or scan the QR code or go down to the link below. Let's review the forecast. Consensus is strongly bullish. There's 38 analysts. The upside is 26% or 29%. Most analysts have a buy recommendation. 21 have a buy. 9 have a strong buy, while 2 analysts issued sells. Consensus is rewarding management's efforts to focus on direct-to-customer sales. They forecast a gross margin expansion of 3 percentage points over the next 3 years, which might be a bit optimistic. The point is that the company is really benefiting right now from really high profitability, high ROIC. And in this table that I'm showing, the consensus forecast shows that analysts are expecting net margin to go all the way up to 15% in 2024 compared to 10% in 2019. So the point is that analysts already have a very bullish case in their numbers. Now, let's review the profit and loss statement first. Net profit is driven by both continued revenue growth and margin expansion. In other words, there's still opportunity to grow. The balance sheet assets, well, defensive balance sheet with a third of assets in cash. They've got a war chest of about 13 billion US dollars. As CapEx requirements are moderate, the company might decide to return part of its cash in the form of share repurchases at some point. Now, the balance sheet size is almost 2 times bigger than its rival Adidas. And thanks to its margin expansion, Nike could see its EPS grow faster than its revenue. And that just shows that the margin is expanding. Nike's gross margin is below its competitors Adidas, which has averaged 49% over the past 5 years. I think that Nike margin is going to rise, but again, that's in the price. So if you want to learn how to value companies like this, check out my 6-week online Valuation Master Class Boot Camp. It starts on March 7th. You'll learn practical stock valuation skills and apply them to actual companies. You'll access the tools, tips, and tricks I use to become a #1 analyst. You'll join a group of inspiring, like-minded financial professionals, and you'll get a job through my network of thousands of financial industry leaders. Save $402 until February 28th. Scan this QR code to learn more, or just go to valuationmasterclass.com/bootcamp. Valuation. Well, let's touch the valuation here. So I'm going to review the A-Stot's investment research stock picking checklist. It was inspired by Peter Lynch's book, One Up on Wall Street. What a great book, where he talked about 10 baggers. That's stocks that go up 10 times. We did extensive research on 10 baggers and found 9 factors that drive long-term share price performance. So let's look at these factors. First, management is committed to growth. That's good. Over the past 10 years, revenue grew at a CAGR of 7.4. Second, growth can hit double digits. Moderate. Emerging markets provide growth, but not more than probably high single digits. Gross margin can remain high. That's pretty good. Nike remains the dominant player. Earnings are predictable. That's number 4. This is weak. There's exceptional items that lead to volatility and net profit. Number 5, efficient at deploying assets. They're good at that. Asset turnover is above average at 130%. Number 6, cash conversion cycle is low. They're good at that also. The cash conversion cycle is 25 days, much lower than the sector average. Number 7, cash flow is consistently positive. Good. Nike delivered strong operating cash flow over time. Number 8, capital is readily available. Good. The company is net cash. There's plenty of opportunity to expand their capital base. And number 9, valuation is reasonable. Well, unfortunately, this is weak. Trades slightly higher on both PE and price to book compared to the U.S. consumer discretionary sector. And I would say, to sum it up, does this company have the potential to be a 10-bagger from here? The answer to that question, I would say, is probably not. I would say maybe a 2-bagger is possible, but I wouldn't say there's 10-bagger potential right now. Now, on the free cash flow statement, we can see that CapEx requirements are low, leading to high and sustainable free cash flow to the firm. That free cash flow to the firm ducked down to about 2.7 billion US dollars in 2020, but it bounced right back to 6.9 billion US dollars in 2021. And I expect it's going to be about the same at about 7.2 or so, 7.1 or 7.2 billion dollars in free cash flow. Now, I expect lower revenue growth than consensus, but higher net margin, leading to a similar earnings forecast. With a 4% terminal growth rate, I'm already on the optimistic side. Also, I assume the company is going to maintain its massive ROIC over time. Using the free cash flow method, I use a cost of equity of 10.5%, a WACC of 9.9 because they don't have much debt, so there's not much to reduce it by. And then the terminal growth rate of 4%, which I feel like is reasonably optimistic. So what do we get from that? A value of 110 US dollars. That's a 22% downside. The bull case is 123, which is a 14% downside, and the bear case is $100. That's a downside of 30%. Now let's consider the company's world-class benchmarking scorecard to identify its competitive position relative to global peers. We use a composite rank of profitability and growth called profitable growth, and a scale from 1, which is best, to 10, which is worst. Number 1 in the world. When you compare Nike benchmarked against 1,010 large consumer discretionary companies worldwide, Nike is basically ranked a 1 almost always in the past 5 years. One time in 2020, it fell to a 2 because of the impact of the 2020 situation. And this is driven by super high profitability and pretty darn good growth. The past 12 months growth is rated at a 4 relative to its global peers. That means growing slightly better than average. So what are the risks? Well, entrance of new players joining the fitness and sports markets with niche products, failure to meet local customer requirements, in particular emerging markets, and consolidations of retail shops might impair the ability to sell. What are the conclusions? Direct-to-consumer selling approach raises brand value and could enhance margin. And early digital expansion gives it timing advantage over competitors. But the valuation is not cheap. I think the bullish rally is probably over. So that gives you my answer on Nike. Let me ask you, is Nike's sports supremacy enough to justify its high valuation? Let me know in the chat below. This is Andrew Stotz of the Valuation Masterclass case study saying, have a great day.